Happy Thanksgiving if you're tuning in the US, and happy Black Friday sales if you're watching down under. My name's Jessica Ramir, market strategist with Mumu. Thanks for tuning into the daily. We cover the top performing stocks this month and if they've got more gas in them. But first, let's cover what happened overnight. Well, of course, remember the US market was closed for Thanksgiving, so attention was totally on the US, and there we saw stocks move up for the first time in 3 days. And why is that? Well, we saw Europe's third biggest company, ASML. It's the chip leader there. Their shares rose 2.4%, and it was for good reason. The entire semiconductor sector also got a boost, and that's because Biden's administration is reportedly suggested to go less harsh on Chinese tech and chip technology companies with the latest round of restrictions. So all in all, that might support the broad tech sector, indeed semiconductor names. So you might expect a sentiment lift in the US tonight when trade resumes there. But let's focus what's happening down under in Australia. So of course, we've been speaking about the Aussie share market trading at brand new record all-time highs. And indeed, this month, we've seen the Aussie share market rise 3.7%. That's the best gain that we've seen since December last year, when the market rose 7.4% in 2023 in December. So why is sentiment so bullish this month? Well, it's for three key important reasons. Firstly, we've been speaking about Australia and the US economy. Both are growing stronger than expected. Secondly, US company earnings, they're growing stronger than expected as well. And of course, we've got the US central bank affirming that they're probably going to keep cutting interest rates. But let's just consider the top three best performing ASX stocks this month to see if they've got more oomph or more gas in them, potentially for you to consider as a potential trading or investing idea. So let's go to Sigma Healthcare. Let's just bring up the chart. We can see Sigma Healthcare, don't know why I put on an NZ accent there. Sigma Healthcare shares are up the most this month, 42%. And why is that? Well, we saw the ACCC come out approving the merger with Chemist Warehouse. So Sigma will continue to remain trading on the ASX. So their shares, I guess, are continued to be favoured by analysts, and that's because we're now starting to see earnings be upgraded for the year ahead. Most analysts are expecting more or less for earnings to grow 35% next year and then 53% the year after. That theoretically does support SIG shares moving up to new highs. But do note that Ord Minnett is the only broker that has got SIG as a buy. Citi, Morningstar, Jefferies do have Sigma as a hold. Average price target, you might ask, taking heed of the price that we can see that it's trading at today, $2.79. The price target, believe it or not, is $1.80. Now, this suggests that that Sigma is perhaps a little overstretched, given they're cracking 174% gain this year. Let's move now to the second best performer on the ASX this month, PME, Pro Medicus. Their shares are up 27% this month. And I guess, why is this? It's all for good reason. In case you didn't know, this company gained their biggest ever contract win, a $330 million contract. That's in Aussie dollars. They'll be providing, I guess, one of the largest non-for-profit healthcare providers in the US with services for 10 years. So the company that they're going to be providing their patient monitoring software to is called Trinity Health, and Trinity Health has got 93 hospitals in the US, about 250 continuing and urgent care locations. So you'd expect that to prop up their earnings. And if we think about what consensus or the average analyst is expecting for their earnings ahead, remembering earnings drives share price growth, we're looking at 31% earnings growth for next year, and then the year after that, 27% earnings growth. Look, obviously, just reiterating, earnings growth should theoretically help support their shares higher. But look, only 3 brokers have got PME as a buy. 9 brokers say it's a hold, given that its shares are already up 161% this year. The average price target out there at the minute is $178.95. Keep in mind, as we can see on the screen, today they're trading at $249. Last but not least, let's pause and reflect and have a moment's silence for Technology One. So well done to you if you've been invested in T&E. So their shares, third best performer this month, up 26%. But look, this business is one to watch. I like SaaS businesses, and this company has gained more contracts. They've beefed up their revenue in terms of ongoing recurring revenue, which is what we like to see. And I guess you might think about this as perhaps a leader of SaaS down under, and the fact that they've reported that 20% surge in annual recurring revenue is a pretty good sign that they've edged out further as the leader in this space. Obviously, we do love recurring cash flows. Indeed, that is garnered favourable by a lot of Wall Street as well. And local analysts as well. So the business is expected to be profitable next year, which is probably why you might want to keep Technology One on your radar. As for revenue growth expected, that could push its shares higher next year and the year after. You're looking at revenue growth of 15% and 14% the year after. So Wilson's, CLSA, of course, formerly known as Credit Suisse, and Jefferies, they're all bullish on the stock, rated as a buy. Price targets as high as $35. But as we can see, it's kind of trading just shy of that at the moment. But look, all in all, you might expect their shares to have a crack on up higher, but keep in mind that there is room for profit taking given their shares are up 98% this year. And if you want more information on any of the stocks mentioned, you can dive into the company data section on Mumu's app. And that's the daily. Stay tuned for the weekly. We'll see you soon.